What is actually going on with AI? Is it a bubble? Just another dot-com crash waiting to happen? Or will it be just like the 2008 crisis? There are a lot of different opinions on the AI bubble, and honestly, they all might be partly right. So half $1 trillion is flooding into AI right now. Companies with zero profits are worth billions. And it feels exactly like the year 2000 all over again, right before the dot-com industry collapsed. I was there and I remember clearly. People lost everything. So when people say AI bubble, they're not joking around. They're talking about real financial devastation. But there are a few critical differences between now and 2000 that could completely change how this plays out. And one of them involves the government and your tax dollars. So I'm going to break down exactly what's happening with AI, what the dot-com crash teaches us, and what you need to know right now to protect yourself. Because whether this bubble pops or not, you need to be prepared. So we've all heard the warning. AI is a bubble waiting to pop. And we've heard the comparisons. It's just like the dot-com bubble all over again. So what does this actually mean? What happens if it bursts? And will it actually be that devastating if it does? Let's start with the basic. What is a bubble? It is when the prices of assets go way beyond what things are actually worth. It's typically driven by speculations and fear of missing out, rather than actual fundamentals, characterized by what people call irrational exuberance. And eventually, it becomes unsustainable and crashes. So what's the AI bubble specifically? Well, we're talking about massive investment, over $500 billion going into AI infrastructure as we speak. Companies with little to no revenue are getting huge valuations. Every company is suddenly adding AI to their business model. Investor money is flooding in based on potential, not profit. Market valuations are increasing, but earnings aren't keeping pace at all. The scale is massive. The US announced their Stargate project in 2025 for up to $500 billion in private investments over 4 years, with $100 billion being deployed immediately. Major tech companies are betting their entire future on AI. Billions are being poured into startups with unproven business models. It really reminds of the late 1990s and the internet gold rush. And here is the thing, we've been there. I've been there personally. The dot-com parallel is impossible to ignore. There's so many similarities. Back in 2000, the internet was definitely the future. And it was. Today we can't imagine life without the internet. But the investors paid insane prices for stocks that had no path to profit whatsoever. I don't know whether you remember, but there were Pets.com and Bull.com and many others. They all collapsed. Shareholders got nothing, zilch. The market plummeted. It was a horrific economic disaster, and it left society really uncertain about investing in unproven tech startups for years after that. So what was the lesson? Well, the lesson was that high ambitions aren't enough to sustain an industry. You need sustainable revenue model, not just a very cool idea. This time is different, is always what people say during bubbles. Companies need to focus on actual profit, not just growth. Back then, fear of missing out kept people piling money on the table. Everyone was looking to multiply their investments. Individual stock picking was the norm. People were obsessed. You wouldn't even call it investing. It was just like gambling at a party. But let's not also forget there were some companies which actually bet on the dot-com boom and won. So Amazon is one of these examples. It started as an online bookstore but expanded into everything. It's one of the largest companies, electronics, media, and eventually they're the dominant global retail and cloud computing company. eBay evolved from auctions to a broader marketplace and recovered its stock by 2003. Even Yahoo maintained its presence in search and email and news, although it eventually lost ground to Google. But there are these companies which actually won. Not everything crashed and burned. Which brings us to the big question. How is the AI bubble different? And this is where it gets interesting. First, investment structure has completely changed. During the dot-com era, it was individual stocks. Now, they're broad-based index funds. This is more the norm. This means that there is much more diversification, which means less individual investor exposure. If AI crashes, your portfolio doesn't go to zero, hopefully. Second, actual products exist this time. Back in the dot-com days, many companies had no product, just an idea. With AI, we have ChatGPT, which has over 200 million weekly active users. And then we can talk about Claude and Perplexity and many others, which are being used every single day. And they generate revenue. The technology is demonstrably useful, not just theoretical. And people are using these tools for work, for school, for everyday tasks. And third, the government is backing AI. The government sees AI as a strategic national interest. This creates a safety net that absolutely didn't exist in 2000. Fourth, too big to fail factor. The major players here are established companies like Microsoft, Google, Meta. These aren't just scrappy startups with no backup plans. These companies have massive revenue streams. It's much harder for them to collapse like the companies that collapsed in the dot-com era. And fifth, we are betting on infrastructure versus applications. The dot-com bubble was about betting on specific websites and services. AI is all about betting on fundamental infrastructure technology. Infrastructure tends to be more stable long-term, comparable to betting on the internet as a concept versus betting on a specific website. Now, here's where things get really interesting. Nobel Prize winner Paul Krugman has been writing about this, and he sees the parallels but predicts a different ending. He said, and I quote, "The bubble may end not with a pop, but with a giant tech bro bailout. This probably won't end with a dramatic crash that wipes people out overnight. It's more likely to be a slow deflation where the government props up failing ventures while the hype fades and realistic valuations emerge. You might pay for it through taxes or inflation rather than seeing your investments crash." So what should you do? Well, first of all, don't panic. Panic doesn't help anyone. Don't bet everything on AI stocks. And remember that sustainable revenue model lesson from 2000. The internet survived its bubble. AI probably will too. Just be smart about how much you're exposed to it.